Hello everyone, we've gathered here today to discuss the impeding monetary policy decision on October the 3rd, 2017 with the board of the RBA. The three main points of discussion will be inflation in the Australian economy, the economic growth and the Australian exchange rate, and the unemployment and underemployment levels in Australia. So Nick, if you'd like to take it away with the inflation rates.
The inflation rate plays an integral role in any major economic decision in contemplation of the Reserve Bank of Australia or government. Measured using the Consumer Price Index, the Reserve Bank maintains a target range of annual inflation of 2 to 3%. However, this is by no means a rigid requirement. The year to the June quarter 2017 saw a CPI increase of 1.9%. However, this figure is forecast to increase to between 2 and 3% for the second half of 2017 and subsequent periods. The current inflation rate is just short of the RBA's target range, however, does not justify lowering the cash rate to a new historically low level. This subdued figure is expected to increase in coming periods with help from higher utilities costs and further tobacco excise increases. Australia's inflation rate is forecast to increase to within target levels in coming periods after a sluggish few months. As the current cash rate is a historically low 1.5%, the rate of inflation does not justify a further decrease in interest rates. It is recommended to the board of the Reserve Bank that the cash rate remains unchanged at 1.5%.
Hello all, my name is Sebastian Canady and I would like to briefly explain the implications of our proposed sustained cash rate on the Australian economy. The RBA wishes to maintain a high level of economic activity in Australia, and we believe this can be achieved through finding a balance between maximising exports and foreign investment while keeping interest rates low to allow the Australian population to invest. In terms of our exchange rate, we can see that this has been growing over the last 5 months, though fluctuating a bit in September. For us, this is an indication to maintain the current cash rate, since the relatively low-cost Australian currency should keep exports at a high level, as well as gain more foreign investors through the increasing Australian dollar. While increasing the cash rate could improve foreign investment, this would slow exports and investment within the economy. And on the other hand, dropping the cash rate further could make demand in Australia too great, and pricing in the economy may increase as a result. Therefore, we expect maintaining the current cash rate will help to retain a high level of production and investment in Australia, allowing the welfare of the Australian economy. Over to Dan.
One of the main parts of the Australian economy that the official cash rate greatly influences is the labour market, including employment and employment remuneration. A lowered cash rate allows businesses to hire more employees as their cost of debt decreases. They therefore are able to gather loans from banks at lower prices, promoting them to hire more employees and expand their business. Since the cash rate was lowered in August last year to 1.5%, Australia's unemployment rate has seen a decrease of 0.1%. Therefore, it is likely that the cash rate remains unchanged for the upcoming month, as the current level has seen improvement in employment levels, which was once a major concern for Australia. Further to this, earlier this year it was revealed that Australian workers are stuck with the lowest level of wage growth in 2 decades at 1.9%. The extremely low rate of wage increase, coupled with the rising cost of living, suggests that the official cash rate should not be increased. However, as the cash rate is already an all-time low and employment has improved, it is unlikely that it should be decreased further. Remaining at 1.5% seems to be the best choice for the Reserve Bank of Australia.
Thanks Dan. So just to summarise the three main points, the first objective of monetary policy is to promote stability in the Australian economy. Although recent statistics showing that inflation rates have been below the recommended rate, they are predicted to go back to inside the target range of 2 to 3%. The second objective of the RBA's policy is to promote economic growth and welfare for Australians. The current cash rate of 1.5% has been effective in managing various exchange rates, and a positive trend relative to the US dollar can be seen over previous months. The third objective is to ensure full employment in Australia. The latest statistics show a downward trend in unemployment and underemployment in Australia, especially when compared to earlier years in which a higher cash rate was being enforced. These reasons above justify our position that the cash rate should remain unchanged at 1.5%.